Hello, everyone. Thanks for joining. We're going to give it just another minute or so here to let people file in, but thanks for joining us. Hope you're enjoying your Friday. Still got a few more coming in. We'll give it 30 more seconds here and then we'll jump on in. Alrighty. All right. Hello, everyone. Welcome to our Q&A session dedicated to understanding the SEC's new proposed climate disclosure rules. Thank you very much for joining us today. I am Adam Servinskis. I'm Gobi's Sales Enablement Manager. So at the beginning of the week, the SEC proposed rules intended to enhance and standardize climate-related disclosures to address investor needs. The next hour, we plan to discuss any questions you may have. And in the past few days, we've already received a ton of questions from the audience. So really appreciate everybody submitting those questions. If you do have questions at any point, you can go over to the questions section in the GoToWebinar control panel, and then we will try to answer those. We're going to try to hit the questions that were asked in advance first, and we'll try to get to as many as we can. Just so you know, the webinar is being recorded and will be distributed to you after the session. And if there's anything that we didn't get to, you can definitely reach out to us and we can chat more about questions you have. So with that being said, let's introduce our panelists for this session. All from Gobi, we have Mari Bishop, who is the Senior Director of ESG, Sam Patel, who is Senior Solutions Architect, and Carlos Solano, who is the ESG Manager at Gobi. Guys, how's everyone doing? All right. That's great. Roll. So let's jump into it. Mari, do you want to just start by giving us an overview of the new proposed requirements, and who it applies to, timelines, just things of that nature?
Sure. Yeah, that'll definitely get us started. And I know that this is probably going to be, very general. That's okay. That's why we're all here, and we'll field questions. I will do my best to put into 2 minutes 500 pages of what the proposed ruling is. But all in all, this is, so first of all, it's super important to mention, it is a proposed ruling, right? So this is not final. If you have had a look at things that are out there that kind of talk about the ruling, or even the ruling itself, you'll notice that there is a request for comments. So there's a lot of questions and a lot of things that are kind of still out there, and they're still trying to get some feedback from the public to finalize it into an actual ruling. But all in all, what the proposed ruling is covering is disclosure of climate-related risks, what they are, how a company identifies them, how they plan around them, and how they track them, and whatever they do, or whether they do something with that information. So, how do they act upon those risks to minimize those risks? And like Adam mentioned, the whole point of this is to try to inform in a more standardized way investors how their investment decisions can be impacted by what we know is definitely impacting all businesses throughout the world, climate change, climate risk. And to kind of open it up a little bit, what does that mean? So climate risk, first thing I'll mention is that it's looking at climate risk into kind of like two buckets, physical and transition risk. what those are, what that entails definition wise, and what aspects are looked into that, and all of that, of course, go into the 500 pages that I mentioned, but it is aligned to TCFD standards and definitions. And as part of that too, because it is, of course, a very important part of climate risk, looking at climate risk, is also that component of greenhouse gas emission tracking. So scope 1, 2, and 3, in some cases, are also covered by the proposal. It applies to companies, organizations, entities that do regular filings to the SEC. So this would be a requirement to disclose these things as part of the regular filings. When does it apply? Probably good news, or maybe not. It is not going to apply right now. It would be in place from 2024 to 2026 for those reporting years, for those fiscal years. And it varies. It's kind of like easing your way into it. Some requirements start sooner than others. And then it does, when some things apply or what things apply do change depending on the entity and the kind of filing that you have to do. So I think that's it in a nutshell. There's definitely a lot more, and we'll dive deeper into it. But I figured Carlos and Sam would want to give their 2 cents on what they've seen, what they've read, what they see so far.
Sure. Thank you, Maria. Thank you, Adam, and thanks everyone for participating. What I wanted to do is really just place us in context on the evolution and how we got here. So it shouldn't come as a surprise, and I know there's still a comment period and there's going to be a lot of comments on both sides of the spectrum. Really, the SEC came out of the market crash in the late 1920s. In the mid 1930s, there were a lot of rules trying to standardize information, and back then we were still just kind of putting in place how do we report financial information. So it's been almost 100 years, and over that time there has been more and more systems in place to try to look at gatekeepers, for example, accountants and assurance providers. And then really in the 70s, late 60s and 70s, the social and environmental movements got started and requested or asked the SEC to put in place some form of some requirement around disclosing social and environmental impacts. Back then, what the court ruled was that it was less than 1% of all investments, so it deemed requiring such disclosures irrelevant. So here we are, almost 50 years later, and there has been some steps towards that. Mainly, over $100 trillion of invested assets already look at climate risks, already ask for this data. So this shouldn't be new. A lot of companies are already doing it, but it is taking a different approach in that the burden is really on the company, whereas in Europe it's really on the investor to kind of get that information. So the evolution is there. Also in the 2000s, we had Sarbanes-Oxley after the Enron scandal, and really kind of breaking a little bit of the corporate veil, if you will, and having assurance providers put their names and saying, this is correct, this information was reviewed, and so on and so forth. In 2010, there was actually some language around climate change. And yeah, won't dive into too much detail on those, but just note that in the context of things, this is really just an evolution that provides clarification between the investing public, protecting them, and making sound financial decisions, mitigating your risk. And really the SEC is trying to be a bridge of providing common ground and understanding the same language. So those are my opening comments.
Yeah, so with this proposal, what we're seeing is also a larger trend, right? So we're seeing a standardization of metrics, essentially. So before this, we had voluntary disclosures such as, CDP, Dow Jones Index, and a lot of other standards like SASB that people used to follow. So what we're seeing here is the SEC aggregating inputs from all of these different frameworks also. So you see a lot of heavy emphasis with TCFD here, and actually creating this proposal here so that people have something that's reliable and standard and that doesn't change year to year, because some of the voluntary disclosures would change year to year, and then some of the reporters might not report every year also. They might report only partial data. So to address that, this proposal has been made, and I think this is a step in the right direction right now.
Absolutely, yeah, and we really see the demand increasingly come from the investor side, and a lot of the comments were from asset managers and investors. So let's talk a little bit about greenhouse gas accounting. I think it would be a little helpful just for people on the call to understand, I guess, what the difference are between scope 1, 2, and 3 emissions. And then Sam, if you wanted to comment at all on thoughts about the inclusion of scope 3 emissions and how that's going to factor in.
Yeah, I think we can start off with what GHG accounting actually is. So greenhouse gas accounting, or GHG inventory, as they sometimes call it, is essentially measuring the emissions of any gas that's contributing to the greenhouse gas effect, which in turn leads to adverse weather or adverse climate. So what are these gases? These gases can be anything that's coming out of combustion. So that can be carbon dioxide, carbon monoxide, methane, nitrous dioxide, things like that, and gases that are coming from refrigerant leakage. So that contributes to greenhouse gas effect as well. So in terms of how we're measuring these, you would want to start first with understanding your operations internally and also externally, and see the sources of where combustion is happening or where there's any refrigerants being emitted. So now we can actually go into scope 1, 2, and 3, which is essentially broken down based on how much control or agency you have over these emission sources. So scope 1 would be anything that you have direct control over. So I can give an example of real estate, right? So if you have a generator in your building that is, burning natural gas, then that is a scope 1 emissions, because that is an on-site emission. Scope 2 would be emissions related to your electricity procurement, right? So that is something that you are consuming energy for, but the combustion itself is happening at a power plant somewhere that is offsite. And then scope 3 is upstream and downstream emissions, which is if you have, say, a vehicle fleet that is contracted, so you don't actually own the vehicles, but you're actually using the vehicle fleet from a third party. So that would be a scope 3 emission. So that's a very simple way of understanding them. And now there are 3 ways of looking at the scopes. There's operational control, which is the most common one, but there's also financial control and equity approach, which looks at if you have financial control or if you have equity and how much equity you have in that asset. And then in terms of the SEC's proposal itself, there is the actual calculation of these emissions. But two things that I really like are actually the breakdown of gases, because a lot of times people just report on the normalized metric based on carbon dioxide equivalents. The SEC is actually asking for the breakdown, which the CDP also does, of the actual constituent gases, which is good. And then they're also normalizing it. So they're asking for normalization based on some sort of industry metric or based on financial revenue metrics. So what that is helpful for is a fair comparison between different emissions, right? So you might have a company, say, 1 million revenue versus 10 million revenue. You want to make sure that you're normalizing based on the revenue to actually compare those two companies equally. So that's where the normalization comes in, and I think that's a good idea. And then the next question you asked, Adam, was regarding scope 3, right? So with scope 3, I see where they're coming from in terms of giving a safe harbor and building in some sort of phase-in period, because at the end of the day, some industries have more scope 3 and some industries have less scope 3 than others. So this will affect some industries differently as the phasing period comes in. But the safe harbor is a good idea because as it stands right now, scope 3, just because of the lack of agency that companies have on collecting this data from upstream and downstream sources, there will be some level of difficulty in getting this data, and also in terms of accuracy of the data itself. So because of that, giving that safe harbor clause in there is good, and it will also encourage companies to, actually collect that information and disclose it. And on a larger scale, also help them understand their operations in a more holistic view rather than just scope 1 and scope 2. And then the exemption for smaller companies is also a good idea, because scope 1 and 2 tend to be more simple to calculate because you also have more agency on getting that data compared to scope 3. And then smaller companies just sometimes won't have the resources to chase down all this data, upstream in their supply chain, downstream with what's happening. So I think that's a good idea for having that exemption for SRCs.
Thank you, Sam. So let's talk a little bit about the assurance requirement. Carlos, do you want to touch on that a bit?
Yes, sir. So one document that is really helpful is the SEC has done a good job of putting a fact sheet that is only 3 pages long, and it really has a couple tables kind of summarizing some of the main takeaways. As far as assurance, this is really targeting large accelerated filers and accelerated filers, and it really faces in for just scopes 1 and 2. So for large accelerated filers, fiscal year 2023 should be reported in 2024. Now there are 2 levels here. That is to report without any level of assurance. So in 2024, you'll be reporting on your emissions on 2023. Now we have limited assurance to be reported in 2025 for year 2024. So you still have a few years. And then finally, what they call reasonable assurance will be the year after. So in 2027, you'll be reporting on 2026 data. What's happening here is limited versus reasonable. These are 2 terms where limited is basically an organization goes in, reviews the data, a third party, and says, we couldn't find anything wrong with this data. And that's kind of a limited scope of reviewing the information. Whereas reasonable assurance, you're kind of putting your name and your stamp and saying, this is correct. Like this is the final word and everything has been thoroughly reviewed. So that is for large accelerated filers. You will simply add a year for accelerated filers. So yeah, that's kind of the scope of assurance.
Awesome, thank you. So Carlos, just want to stay with you for a sec. So you gave us that sort of historical context. How do you see it moving forward as far as ESG growth? And I think this is maybe combining questions, but what sort of comments do you anticipate coming to just on this these proposed disclosures?
Yeah, so what I believe for ESG, I think this is kind of the end goal of sometimes our careers is that in ESG, that we don't need a specific ESG title because it's just incorporated into everyday business. I think this is one step in that direction. In that one almost cautionary takeaway here is really putting the systems into your accounting schedule and into your accounting process, because they're really the most effective at gathering data from across the company, across departments, and reporting that. So this will put just an extra layer of gathering just one new layer of information. So really, you want to make allies of the accountants in your company. So that's kind of where the future is. Maybe ESG professionals will really kind of become friends with accountants. And I'm sorry, I missed can you repeat the second part of that question?
Yeah, well, as I was asking, I was realizing they're not
the comments.
Yeah, what comments and how do you see this moving forward?
Yeah, very briefly, I expect a lot of pushback from industry, given that companies and not investors are the ones being required to file, but also a lot of support from a broader set of stakeholders, including investors, because they know, let's say you and I are responsible for paying the pensions of thousands or hundreds of hundreds of thousands of employees, as a lot of these investment managers do, you're looking at a 10, 20, 30-year horizon, and you know this is a risk. So they are a strong ally in helping standardize this. So, you know, and then for smaller companies, they might be asking for more leniency, a little bit of a longer time period, you know, kind of the usual. But as I mentioned in my opening comments, this shouldn't have come as a surprise, and it's really an evolution that is really welcome.
And if I could, Adam, to just add to that, because I know that there's a couple of questions I see on the chat about it too. I think big picture, we've all mentioned already, it's a step towards the right direction, but I do think in some ways it falls short. If you have had a look at kind of the guidance that they're providing or the requirements that they're mentioning, the vast majority of it is disclose if you have it. You know, if you have this, then yes, there's a lot of different, you know, guidance on, you know, what to disclose, how to disclose it, explain why you didn't, if you decided that this is material or not, and that kind of thing. But a lot of it is, at the end of the day, you know, for example, target setting. It does not require target setting, but it says if you do have targets, disclose how you came up with those targets and how you track them. And you know how you plan to transition into whatever that target is, if it's a net zero goal, for example. But it is not requiring that you have a net zero goal. It is not requiring that you lower your emissions by a certain amount of percentage. It's not requiring that you you know, meet the Paris Climate Agreement goals or some other you know, threshold or standard. It's requiring that if you do something around climate risk, that you align it to TCFD and, you know, the 2G protocol and other things, but it is not requiring for you to have it. So I think that's the place where, and to Carlos' point, you know, we expect a lot of pushback. If they were requiring all of these things, there would certainly be a lot of pushback. It's not something that can, you know, change from, you know, from night to day in the US, but it's also something that we see happening outside of the US. And I think that's, to me, that is the main difference from EU regulation. EU regulation is telling you that you have to set a target. It is telling you that you have to meet a certain target, what that target is, and by when. It is also requiring that you track and, you know, and disclose on things in a specific way. In this case, it's more talking about, I think, perhaps outside of, you know, yes, you have to disclose your scope 1 and 2, perhaps 3 emissions. Everything else is disclose if you have it. So at the end of the day, the companies are the ones having to, you know, do this. I think it is still, the weight is still on the investor to be the one that is setting the bar and saying what it is that they want to see, expect to see. And what we see at Gobi, I think, and, you know, Sam, Carlos, if you agree or disagree, have anything to add, please do. But what we see at Gobi is, in those cases, what investors are doing, instead of having, you know, a jungle gym full of bars and figuring out what should meet what bar, they look at the highest bar and they try to have everything kind of, you know, match to that or translate to that one way or another. So step in the right direction. But I think it's still, you know, the bar is still higher for EU regulation, and I still expect that investors will be looking at that bar.
Yeah, to go to that point also with the comments, I kind of see this coming from 2 different camps with public markets. So there is a large section of the market which is already doing CDP. You know, they're already TCFD aligned. So all of them, they're already way ahead of this already. You know, this is sort of catching up to them. And then there's the other part of the industry that is not doing that. So that's where you might probably get the pushback from. And also some high carbon intensity industries also, they might have some pushback on this. But yeah, I agree with Mari's point on, you know, just disclosing emissions is a step in the right direction, but definitely having some more requirements for how they're implementing that, and actually having targets and meeting those targets actually gives teeth to the proposal. And hopefully that comes through in comments.
Yeah, and I think really to get into the mind of the SEC, they have been really astute to ask section by section questions. So you can really see from their own questions. So if you look at, it's over 500 pages. I think none of us had fully digested all that, but we have kind of tried to share notes and try to break it down a little bit. And at the end of each section, it says propose comments, like please comment, like they want your input. So you should engage, and they have very specific questions. So one of those is, should we do away with the safe harbor for scope 3? I would disagree. I agree with Sam's comments. I think a lot of people feel like they'll be opening themselves up for litigation. So little things like that. There are very specific comments that you can address. And just to extend on Mari's comments on the EU, since I see one of the questions in the panel, in the list of questions here, is trying to compare to EU standards. The EU has come up with what they call the CSRD, the Corporate Sustainability Reporting Directive. And really the main takeaway here is that those are the two approaches. They're mainly heavily focused on investors, so money managers, asset owners, and really the difference between materiality. So here in the US is what we're calling, there are new words being thrown around, single materiality, which is very heavily focused on financial materiality. So you'll see things like SASB, which has been rolled into the Integrated Reporting Foundation, into the ISSB, which is directly mentioned by the SEC, is the International Sustainability Standards Board. And they're not saying that they're going to do everything that they recommend. They take elements, the best elements that they see fit for the US market. So for example, they're not requiring things that the ISSB does require, such as remuneration and some sort of tie-in into ESG outcomes. They're not doing that here in the US. Whereas in Europe, they're talking about double materiality. So it's not just considering the investors as the sole consumer of this information, but they go through a larger exercise of considering GRI, the Global Reporting Initiative, and almost a larger set of stakeholders. So yeah, I agree with Mari. It's definitely more stringent, more difficult perhaps to report in Europe, but they also have a phase-in period, and yeah, their limit is 500 employees for a company. So those are fairly large companies. The limit here is still, again, to Mari's point, it's a proposal. We'll see what the final number ends up being. But there was just one, I'll close with this. Somebody mentioned the threshold for various requirements. And specifically, somebody says, leaves the company to decide if GHG is material. Isn't it subjective? Well, there's one case where, for example, excise taxes are usually a percentage of the cost of something. So for example, they're saying about 1% for every line item in a P&L. We'll see what the final number is, but they're almost kind of like setting the bar of materiality for you. And we'll see how this is received. I think it's helpful to have a standard and everybody doing things the same way, but it's also it might be a little bit difficult for, as Sam was mentioning, smaller organizations, and that's where the devil's in the detail. And I think this the final comments are really gonna be over these minute points with a lot of accountants and lawyers jumping in on both sides. For us, it, of course, is welcome, but I do feel the where the pushback might be coming from.
Awesome. All right. So we have a question around what does it look like as a company when you're tracking and planning for climate-related physical and transition risks?
Yeah, I can take that one, and then Sam, Carlos, however you want to jump in, please do. So I guess first let's talk a bit about physical versus transition risk, and what the difference is. So physical risk, I think, is where everybody's minds go to when you're thinking of climate risk is your hurricanes, sea level rise, and increase in temperatures, flooding, so on and so forth. And then we have transition risks. Now, transition risk is a lot broader, and I think it's a lot more unexplored than the physical risk portion. I think physical risk is something that most companies are looking at one way or another, even if it's just for insurance purposes. But the transition risk is a little more broad, open to discussion and customized to the company. And it's looking at how is your company planning for what might come next, whether you want it or not, and it's something that you're actioning or having a role in, or whether it's something that is a target that you set for yourself. So it is coming from you. The future is coming from you. How do you transition into what's coming next, or should come, or could come next? That can involve a lot of things. That can involve transition into a future where one of the main things that you'll see from this proposal, thinking about how does the transitioning into a new future where the average global climate is 1.5, 2, or 3 degrees Celsius higher, or where there's, depending on geolocation of the company or the asset or whatever it might be, where there's a significant increase in sea levels, or more hurricanes and that kind of stuff. How does it look like to kind of transition into, move your company in the next 10 years, 5 years, short term, medium term, long term, to adapt to how the new future would look like? That can be changes in regulation as well. It can be the changes that you have to take in internally, budget wise, to accommodate to meet your net zero goal that you have for 2035. It can mean a lot of things. What a transition risk is would have to do with what risks are material for a particular company. So that's why it's much broader. And I think it tends to be more difficult for companies then to define it and to talk about how they track it and to figure out how to track it, and to potentially disclose it as part of this proposal. So I think that part is going to be the most challenging one per se. And companies are doing some of it, and we see it with our clients. They're certainly doing some of it already, but it tends to be something that is not systematically tracked, or has an actual system or structure as to how you define it and what you do about it. So what that looks like, I think on the physical aspect, I already covered. One of the most common ways is your budget, your insurance premiums, your how you assess your company's operations and how you change them, is definitely more related to kind of your everyday. But as part of this proposal too, sorry, other things that are mentioned are whether you are aligning to some climate scenario planning. So having multiple scenarios, multiple pathways that you're looking into, not just, okay, the most likely path, where we're likely going in 5 years, and I'm planning against that. Some companies, and it is also something that is kind of the industry best practice, to have multiple scenarios. So describe what those scenarios are, how often you track for it, who is ultimately responsible for the disclosure and the decisions that relate to both physical and climate and transitional related climate risks. And what your transition plan is, exactly how does that look like, and all of that. There's a lot of detail that goes into that, or can go into that. But again, going back to my point before, it's not telling you that you have to do these things. It's just saying if you do have, if you are looking into these risks, how do you look at it? Who's tracking it? Who's responsible for it? So on and so forth. And I think last thing I'll mention, I know we touched on TCFD a couple of times. Definitions for physical and transition risks and best standards of how to track those in this proposal are heavily aligned to TCFD, or the Task Force for Climate-Related Financial Disclosures standards. So I would say that's something that companies, if this is top of your concern, top of your plate, getting familiar with TCFD would be a good idea.
Great, thanks, Mari. So we had a couple of questions on commercial real estate. So how will this impact commercial real estate, and what are your guesses for how the SEC will define materiality as it pertains to real estate?
Yeah, go ahead. I feel like I talked so much already. Carlos.
Oh, no problem at all. I'm not sure how much they will go industry by industry. They're not quite explicitly mentioning SASB, for example. So I don't think this will go precisely under the SEC. It might be the PCAOB, the Public Company Oversight Board. But so I would say it will be, across the economy, the definition of materiality. And going back to what I opened with, it was materiality was kind of evolved during the time of the 70s, right? The concept of materiality really kind of, I guess, set the bar at a percentage of cost or revenue, and that's kind of how it's measured here. Materiality changes industry by industry, so that is a good question. I'm not sure that they will be defining industry by industry definitions of materiality. Just really quickly, I did find, so Control F will be your best friend in browsing through 500 pages. Somebody asked the limits on small organizations. The SEC estimates about 1,000 registrants will be affected by this proposed rule that are considered small entities. Basically, they're above this threshold of a small business, small organization, or small entity if it has total assets of $5 million or less, or if a securities offering or issuing does not exceed $5 million. So that's fairly small, probably a lot smaller than the Europe initial phase that was 500 people. I would guess that a company with 500 people will have more than $5 million in revenue. So sorry, I kind of went outside the question for a second. Just wanted to tie that back.
I just wanted to chime in on the materiality definition. So the SEC does actually have a definition for materiality, and they had it before this. Outside of this, they define what is material, and that's kind of the definition they're using so far. But it's also one of the things that they're asking comments for. So that is also up for discussion. Should we keep the definition of material as we have so far? And that is, a matter is material if there is a substantial likelihood that a reasonable investor would consider it important when determining whether to buy or sell securities or how to vote.
Yep. I'm going to keep it, I'm going to go a little out of order here, but I'm going to keep it on the topic of materiality. We received a question. Do you think the proposed rules sufficiently address the idea of double materiality? And Sam,
I would say, oh, sorry.
Yeah, might also be helpful too to give a quick definition of double materiality.
Yeah, I can jump in there. So with single materiality, we're talking about how material it is to the organization itself, so impact to the organization. When you're looking at double materiality, you're looking at how important it is to the stakeholders surrounding the organization. Those stakeholders can be society, nature as well, right? So that's where ESG comes into play. So that's the biggest difference that you see actually between this proposal and what you have in the UK and Europe is lot of the standards there are also taking in social and governance metrics and questions into play. Here, it's only focused on the carbon aspect of the E of ESG, right? And that is very, very focused on, the impact of the organization. And you also need to take into account where it's coming from, right? So the SEC is looking at this from a fiduciary responsibility angle, hence the focus is on the company only. So that's where single versus double materiality comes in. And yeah, it's based on single materiality, and this is sort of the proposal that's coming out of that.
Great. All right, thank you, Sam. So let's talk a little bit about private companies. You had a question in the chat. What impact do you see this having on value chain suppliers that are not public reporting companies, but their clients are reporting? And, if you could speak just generally to what private companies can take away from this, I think that would be very insightful. Carlos, calling on you.
Okay. Sounds good. Let me go unmute. It's a good exercise that a lot of organizations are already going through. If we think about the private equity model, most often is we buy majority stake or we outright buy a company, and we try to improve its operations, its efficiency, and say 5 years time, sell it at a much higher valuation. Part of that story has been, well, we have an ESG angle to this model, and we're improving not just operations and finances and accounting, but we're also improving maybe our impact on different, let's say, E, S, and G categories. So this has been hotly debated over the past almost 10 years now, especially in the past couple of years. You saw the SFDR in Europe, the Sustainable Finance Regulation that came out. And for private equity, that may not be part of the increased value proposition anymore. It is kind of becoming just business as usual, like everybody has to do it. So I think that's welcome news for a lot of asset owners. So those pension funds that invest in private equity, they sometimes are the ones asking a lot of those questions. Well, now they will have the data. However, since they are private, if part of the company's journey is to one day become public, they need to start preparing for these. So I wouldn't say it's an immediate concern, but it should definitely be assessed, and you should definitely, if you don't have the internal expertise, at least do some light assessment of what that exercise would look like. If you work with an accountant, if you work with, for example, some of the big four, they definitely have ESG teams that can help you assess the impact on their end. So just a few comments there. There are a few more nuanced opportunities, both opportunities and risks. So private equity is definitely watching this very closely.
Great, thanks, Carlos. And I just want to remind everyone, we have about 15 minutes left. If you do have questions, again, feel free to put them in the chat, in the questions comment, and we'll try to get to all of them. So we got another question. How can this proposal impact the financial services industry with non-environmentally focused investments? Sam, do you want to tackle that one?
Yep. So when you're talking about non-environmentally focused, I'm just assuming that is some industry or business that is perceived to have a low environmental impact for this question. So that being said, so at the end of the day, they will still need to measure their scope 1 and scope 2, the business itself. But when it comes to the financial firm measuring that, for them, it'll actually be scope 3. So they have a longer runway to actually get that information, because all emissions from an investment are actually under scope 3. Yeah, I think they still need to go by this proposal here and keep it on the radar, but they will need to do more of engaging with their companies that they own and getting that information. One thing that they will need to keep in mind here is probably if it's non-environmentally focused, as they say. I'm assuming that's something with low environmental impact, right? So maybe looking into the normalizing factors that they're using. that would work best for that industry. So they're actually disclosing something that that's relevant for that industry, in terms of metrics and measurement of impact. Because at the end of the day, every industry has some sort of impact. There will be some carbon emissions in one and two somewhere. So it's still relevant in some.
Right. There's some level of exposure and risk regardless of who you are.
Yes.
So will these rules apply to all companies that have issued stock to investors, public or not? How will oversight of this disclosure be done? I'm going to call on Carlos here again, but yeah, how do you see oversight being handled, and how do you apply for companies that have issued stock to investors already?
Yeah, something else that came to mind just really quickly to close my previous point is what you may expect some of the points being made on the opposition of parts of this rule would be that it may, you will hear things that it will stifle competition or reduce creativity, or it may keep private companies longer. So these are all things that are not unfounded, but are not, it's not coming out of the blue. And a lot of asset owners and asset managers already track this and request this. So I would say that it should be a limited concern. And to your question about how this will play out in the actual implementation, I would say that they are also including a safe harbor on future on comments on future performance. So you have regulation 10K, which is the annual filing. You also have regulation SK, which has the MD&A section, the management discussion and analysis, which usually is at the top of 10K. And that's usually either the board or management, the executives, talking about how, just giving context to the reports and just saying, it touches on a bit of strategy, if you will, about the future of the organization. And if they're putting a safe harbor on that, if they're going to include some comments around climate change, I think it's welcome news as well. I think we could use that transparency to inform how they're looking at things, how they're planning to manage these risks, without necessarily feeling like they're opening themselves up for any scrutiny, either by regulators or investors. And as far as yeah, so I'll kind of leave it at that. I think that the focus will be over the next few years really on gatekeepers, so the accountants that will be assuring a lot of this information. So I'm not particularly worried about any immediate consequences of anybody, getting into trouble for these things. I think there are plenty of safeguards to and plenty of time to get yourself up to speed and to put the systems in place to be compliant.
Great, thanks, Carlos. Sam or Mari, if you want to comment on this, we had a question. What impacts do you see this having on the retail industry?
Yeah, I definitely see some impacts with this. It sort of depends on form of retail. Physical retail versus online retail will have very different impacts. Physical will have more exposure compared to online, with respect to actual stores. That being said, depends on what their distribution model looks like, right? So if they have big distribution warehouses, that's another exposure piece they need to look at. On the scope 3 side, this might open some more discussion for both physical and online retail in terms of supply chain, where the risks are within the supply chain as well. There is the Retail Industry Leadership Association, which is probably going to give a few comments regarding this. So, there's a few other industry groups in retail as well that are probably compiling their feedback for this. So, good place to go and see what's happening there. Mari, I don't know if you have any comments on this as well.
Not much else to add. I agree with what you covered. I don't, with regards to, how the retail industry might define, or might track against, the different kinds of climate risk, I don't think it would be much different, more strenuous or, Of course, depending on the industry itself, the reporting and the compliance and the disclosure is going to look slightly different. But at the end of the day, I mean, that is why the SEC is being, I think, pretty particular about what they're aligning to and what, you know, each company should be looking at to kind of format it and make sure that they're meeting all the requirements. So I don't think there's much special or different besides what Sam already added.
Great, thanks guys. So there was a question, will this call be circulated? Yes, the recording will be sent out to everyone. You know, you guys each touched on this in various forms on this call before, but just talking about getting ahead of the curve, we had a question that is, what impact do you see this having on insurance industry leaning in and providing solutions? For example, will companies taking positive mitigation steps now see favorable consideration from insurers moving forward?
I can offer just my 2 cents. And just to add to what Sam said, actually, on retail versus online, I think retail will have more physical risks, right? If they're within 100-year flood zones and things like that. Whereas online, like Sam mentioned, if they have big data warehouses, they're exposed to a lot of emissions and related carbon cost or regulations and how to transition to lower that. I think that's more on the transitional risks for online. And then regarding, I'm sorry, can you repeat that? I have
Yeah,
new father brain.
that's all good. Now the question was around companies that are taking positive mitigation steps now or who are
with
already.
insurance.
Yeah, how is that? Yeah.
Yep. Okay. Sorry about that. I think it has been going on for a while now. So a lot of insurance companies already include a lot of these types of risk. If you are, like I just mentioned, if you're within a 100-year flood zone, which is a particular kind of technical word for the propensity of where that asset is located to be flooded, and what systems do you have in place to be ready for that. If you have an investment strategy of only investing in beachfront property, well, good luck with your insurance premiums or in the next few years. But yeah, those things are already being incorporated. I don't think it's anything new to insurance companies. I would say it would be part of the company's strategies on where they place assets and what kind of retrofits or upgrades, or if it's a new infrastructure, what kind of added costs you'll be looking at to be ready for those. Or I would say just work with your insurance provider and say, if I implement this, would you give me a lower cost, or those types of things. Also, there is a market for, you could put out, you know, for things like green bonds or blue bonds, or things that are earmarked for efficiency. So if you meet certain efficiency thresholds, your loan basically has a lower interest rate. So I will go out to the market and request, you know, let's say a retrofit green bond. So that's an option for companies.
Thanks, Carlos. So Sam, which scope do carbon emissions for built materials like concrete and steel fall under for GHG?
Yeah, so it depends on who is reporting that. So if it is a steel manufacturer or manufacturer, then it's their actual emissions, right? So then will be scope 1, scope 2. But if this is coming from someone who is in real estate development, and this is upstream in their supply chain, so they're procuring these materials, then will be scope 3 for them. And that will be referred to as embodied carbon.
Thank you. All right. For a private company to access the public capital market, will the capital market require the same thing as the SEC? Thoughts there?
I would say the jury is still out on this one. Again, it's a proposed rule, and I think it will mainly affect public companies, publicly traded companies. I think they're leaving out pink sheets or microcap or smaller companies that are also traded. were smaller exchanges. I don't think that a private company will be held to the same scrutiny as public ones. So I would say it may not be a valid concern quite now, but we will see how the next few years play out.
I think perhaps not regulation wise, you know, that you won't have to, you won't be required to, but at the end of the day, because we all love standardization, or we strive for it as much as possible, it is still going to be like what I was covering earlier about investors, you know, they're still trying to look at everything under one set of glasses. So having, you know, one side of the market be required to do certain things, I think at the end of the day pushes the rest of it to get pretty close to it.
Agreed.
Awesome. Thanks, guys. So that covers all the questions. Really want to thank the audience for tuning in today, and Mari, Sam, and Carlos, really appreciate you all answering these questions and taking time out of your day as well. As a reminder, again, this will be sent out via email. This was being recorded, and if there are any questions that you have in the audience, feel free to reach out to us. You know, we'd love to have a conversation and see how we can help, or just, you know, chat more on this. So with that, thanks everyone for attending, and have a great weekend.
Happy Friday.
Yeah. Thanks, Adam. Thank you, guys.
Thank you guys.
Thanks, everyone.
Cheers.